with our prior period error there, right? Remember, we did look at changes in accounting policies, and then weekend we looked at change in accounting estimates. So I want to look at the last one, right? The last one is prior period error. All right. So after this, so tomorrow we're starting financial instruments. All right. So we'll be looking at financial instruments. I'm sure we'll do maybe 2 or 3, maybe 3 classes. All right. 3 classes on financial instruments, and then we'll be done. All right. So anyways, in tomorrow's class, try to have your financial calculators, right, close by, because we'll need it when you're looking at financial instruments. Okay, cool, guys. So now let's look at prior period error, right? What is a prior period error? And how do we go about that? So prior period error now, guys, all right? This is a mistake that was done in the previous financial statements. All right, but was identified, but was only identified in the current year. All right, so that is what we call a prior period error. All right, we can all agree that we are all human beings. All right, so sometimes instead of recording sales, all right, you can record the sales amount. Maybe you can record it in the purchases. All right, you can record maybe machinery. All right, instead of recording in the machinery account, you can record it in the expenses. All right, so those are some common types of errors. So in regards to errors, guys, there's no specific one that I can tell you that these are the common errors that they give you. All right, there is no specific one. It's just a mistake. The best that I can do to you guys is to give you an approach. All right, how do you deal with an error? All right, so now the approach that we use, all right, when you're looking at error, we'll first look at what is the effect of correcting the error on the statement of profit and loss. All right, remember, we did use this approach as well when you're looking at changes in accounting policies. Right, so you do look at that. And then the next one is, what is the effect of correcting the error on statement of financial position? All right, so that is how we deal with the changes, the prior period error. We look at what is the effect of the error in the statement of profit and loss, what is the effect of the error in the statement of financial position. All right, let me just give you a simple example. All right, so in this example now, we could be looking at a scenario in which the company now, all right, so our company, the junior accountant recorded transport cost as an expense. Maybe the transport cost for machinery as an expense in they recorded the transport cost as an expense, maybe to an amount of the transport cost amount is, maybe it is 10,000. All right, so the error was, maybe let's say it took place in 2020. Right? So the junior accountant recorded transport cost for machinery as an expense in 2020. All right, the transport cost amount is 10,000, and then machinery is depreciated at 20% per annum using straight line method. Just as a small example. Right. Now, in 2021, or maybe in 2020, yeah, in 2021, all right, the directors discovered the error. Now I want to show you guys, all right, what is the approach? How are we going to think through things in this regards? Now, let's look at it. First things first, all right? Transport cost for machinery. What is the correct thing? We're supposed to be added to the cost of machinery. We can all agree that when we did property, plant, and equipment, we did so that transport cost, all right, of machinery, we add them to the value of our asset. That is what we did look at, right, when we're looking at the cost of our assets. Now, however, our accountant made a mistake, all right? They treated it as an expense, the transport cost. Now, let's look at what is the effect of this. On statement of profit and loss. All right, want to correct this error. Let's try to correct it. What are we going to do in correcting this? So in statement of profit and loss, we are going to decrease transport cost, right? Right? Remember, we said this cost should be added to property, plant, and equipment. So which means the transport cost, we reduce it with 10,000. Now, we record the transport cost under machinery. What do we do to machines? We can all agree that we calculate depreciation in machine, right? So that means there's going to be depreciation, increase in depreciation on machine, all right? This is what's going to happen. So what is how much? 20%, all right, assuming we bought it at the beginning of the year. 20% times 10,000, all right? So there's actually an increase. See that? So there is that. So what is the net effect in the statement of profit and loss? Is a decrease in expenses. You guys see that? Of how much? There's a decrease in expenses of 8,000, right? So overall, our expenses are supposed to decrease with 8,000. Then when we decrease expenses by 8,000, right, what then happens to the statement of to profit before tax? If we decrease expenses, we can all agree that profit before tax increases. So there's an increase as well in profit before tax of 8,000. Now, when we increase profit before tax, what happens to our profit? Also, our income tax. There's an increase in income tax expense, right? Depending on the tax rate, if we're using 28% as our tax rate, we then multiply with 8,000. So it will give us that. And then the net effect will be increase in net profit, right? So we have a net increase in net profit, which is the net of these amounts, all right? So that's what we have then, all right? And then, but usually under normal circumstances, you wouldn't want your net profit to be sitting on a negative amount, right? So what do you do? So what you do now is you change your signs. So the decrease in transport cost, you record it as a positive amount, all right? And then the increase in depreciation, you record it as a negative amount, all right? And then, of course, you have a net decrease there, you record it as a positive, and then the increase there, you record it as a negative, like that, so that you end up with a positive net profit. If it was a net loss, you would want it to remain as a negative amount, so that's where you can have it in brackets there. All right. Then you come to statement of financial position. All right. So in the statement of financial position, what is going to happen? Remember, transport cost did not have an effect in the statement of financial position. But what's going to happen? You have an increase in property, plant, and equipment, or machinery. All right? You could have called it machinery or property, plant, and equipment. Now, we record assets in the statement of financial position at what amount? At cost less depreciation, which is the carrying amount, right? That's how we record our assets in the statement of financial position. So it's going to be the cost is 10,000 minus depreciation of 2,000, which would mean now you're going to record 8,000 there. All right, there's an increase in machinery. Then what happens in regards to your deferred tax? Now, if we increase machinery, we can all agree that it also results in increase in deferred tax. All right, so your deferred tax now it will be 8,000 also times 28%, which will give you what? Like that. And then when you increase your assets, and then you also increase the liabilities, the net effect is what? Increase in equity. All right, remember, the increase in assets is more than the increase in liabilities. Assets minus liabilities, it gives you equity. So which means the end result is an increase in equity, which is the net of these amounts. So you're sitting with that like that. Then what happens to the next thing? You have an increase in retained earnings balance. All right, so which means you have to adjust your opening balance of retained earnings. All right, with how much? 5760. All right, so in this regard, you are saying, all right, so you're saying you have increased your equity with 5760. This amount is going to affect your opening balance for retained earnings in the following year. So you adjust it like that. All right, so that is how we go about it with regards to prior period errors. I don't know if there's any questions before we look at an example. Any questions before we move on to the next example? Right.
No questions from our side.
All right, cool. So let's move on to this.
Question from my side. I've just joined in.
All right, let's look at the small example and see what is going on. All right, so the next example now, it says prepare the statement of profit or loss and other comprehensive income, the statement of changes in equity, only the retained earnings sections and notes to the annual financial statements of SARS Limited for the year ended 31 December 2012. Your answer must comply with the requirements of international financial reporting standards. All right, so in terms of this part, all right, let's go to the question and see. All right, so SARS Limited, statement of profit and loss and other comprehensive income for the year. All right, so it looks like that. And then we have profit before tax, income tax, and all that. Extract from the statement of changes in equity for the year ended 31 December 2011 and 2012. So we have our information looking like that. Additional information. After the financial statements for the 31 December 2011 had been published, the directors of the company discovered that the machinery with a cost of 50,000, which had been purchased on 1st of July 2011, had been expended as raw material purchased instead of being capitalized. The company uses a periodic stock taking system for inventory control. To date, no adjustment has been made in the accounting records of the company. The company depreciates machinery at 20% per annum according to the straight line method, which is an agreement with the policy applied by the SA Revenue Service. Assume a tax rate of 20%. The SA Revenue Service will issue a revised assessment in respect of the 2011 tax year. Ignore the implications of VAT. All right, let's look at this question, all right, and see now what is expected of us. So, in this regard now, we can see, all right, they made a mistake, all right, they made an error there. So what did they do? They purchased machinery, all right, but however, it was recorded under raw materials. So that is the mistake that actually transpired. Right. So let's look at right. So in terms of this, all right, of course, before you do anything, you can start off with your workings, all right, in terms of the prior period error. All right. So you're thinking through things, all right? You want to understand what is going on in terms of your error. So you're going to have, all right, so this amount, it was recorded in inventory, all right, at an amount of 50,000 in 2011. So how is this going to affect our statement of profit and loss? Right. Inventory, guys, we saw when we did change in accounting policies, inventory affects the calculation of cost of sales. All right. So in this regard, the purchase of the machinery, it was recorded as an acquisition of raw materials, which means it was recorded under what? It was recorded as purchases. So which means now, in that regard, purchases, we take opening inventory plus purchases minus closing inventory. That's what gives us cost of sales. So in this regard, we are going to have a decrease in cost of sales, all right, through purchases, all right? So we have a decrease there in cost of sales through purchases of 50,000. So we're saying, let's reverse what you did, right? So we're going to reduce our purchases with cost of with 50,000. And then what is the correct thing? The correct thing would be to record this machinery. So we're going to record it under machinery. The 50,000, we record it under machinery. But however, now I want you guys to see something. However, now, right, in this regard, the machinery is not recorded in statement of profit and loss. We can agree. But depreciation on machinery is the one that is recorded in statement of profit and loss, which means now we are going to have increase in depreciation of how much? 50,000, which is the cost, times 20%, right? Remember, the depreciation rate that they're using is 20%. Now, I want you guys to see something. The machinery was acquired when? On 1st of July, 2011. What is our year end? 31 December, 2011. Can you see? We bought it 6 months before year end, all right? So multiply with 6 out of 12. So this is the correct depreciation that we should recognize. All right, so we have, we can record this one as a negative, right? So it's 50,000 times 20% times 6 out of 12. So in this case, it's 5,000. Now, what is the net effect of this? This is you still doing calculations. Can you see the net effect is actually a decrease in expenses on the statement of profit and loss. So you have a decrease in expenses of 45,000. Then you go to your prior period error note. All right, so you have to come to your prior period error note. So you write down, of course, you can give a small indication, right, of what happened. All right, so in this case, you can record that machinery acquired at 50,000 was incorrectly recorded under raw materials. All right, so you can record machinery acquired. So you give a summary of what happened. Machinery acquired on 1st of July, 2011 was incorrectly recorded under raw materials. All right. And then you state now that the error has been adjusted as follows. All right. The error has been corrected or has been corrected as follows. So you then show the users now how was the error corrected. So in this case, there's a decrease in expenses. All right. So in this regard, we saw there that our expenses are decreasing by how much? So you did work it out with 45,000 there. So your expenses are going down with 45,000. In which year? In 2011, the year the error took place. So in 2011, you're going to decrease the expenses by 45,000. All right. Now, what happens to income tax when you decrease expenses? There will be an increase in income tax. All right. For how much? 45,000 times 20%. Because you record it as a negative. Why? Because you want to use it to reduce. All right. You want the decrease, the increase in income tax to reduce your decrease in expenses there, so that at the end you show the effect on your net profit. So at the end we have an increase in net profit after tax. All right. So your net profit after tax is actually going to increase like this. Is there anyone who's lost so far? Anywhere. All right. When you feel like you don't understand somewhere, please do let me know. Because now, when we do the revision class, all right, we might not really get a chance to explain things the way we are doing. So please, if you feel like you're lost, let me know. Anyone who's lost, guys?
Hello.
Yes, ma'am.
Why are we recording increase in tax expense as negative?
Okay. So the reason why we're recording the increase in tax expense as a negative is because, remember, at the end of the day, we want our net profit. We can see there's an increase in net profit there. We want the increase in net profit to be positive. All right. Remember, net profit is going up. So we want it to be positive. So what did we do? The decrease in expenses, we record it as a positive amount. All right. The decrease in expense, we record it as a positive amount. So the decrease in expense is netted off with the increase in tax. So that is why now you find when you look at in taxation, we had to carry out a negative, an opposite sign. Remember, decrease in expense is a positive. So which means the income tax had to carry an opposite sign, which is a negative, so that the two amounts, we show that these two amounts are netting off each other. So in other words, they're decreasing each other so that we end up with an increase in net profit there. I don't know if I did answer you in that regard.
You did answer me, but I still don't understand. It still doesn't make sense to me.
Okay, so you wanted it to be positive.
To show that it's increasing.
But remember, at the end of the day, income tax, what do we do to income tax? Income tax, we record it as a negative, isn't it, in the statement of profit and loss? Remember, decrease in expenses. Think of it this way. There are two ways that we can explain this. An expense in the statement of profit and loss, you record it as a negative, right? So when your expense decreases, all right, when your expense decreases, it means it's carrying the other sign, all right? Remember, to decrease an expense, which means you add it. Let's say, for example, you have rent.
Yeah, that part I understand. That part of decreasing the expense, because when we calculate the expense, we'll say gross profit less expenses.
Yes.
So it needs to be negative. So if
Yes.
we have to decrease the expense, we have to add it back. That part
Yes.
I understand.
Yes.
Oh, okay. Now I get you. Because also the income tax is supposed to be negative. Hence, when we increase it, it has to be negative because it's negative to negative. Now I understand.
Yes,
It's
so
fine.
income tax is already negative. Yes, that's correct. All right.
Oh, okay, thanks.
All right, cool. So basically that is where we are, all right, in regards to the statement of profit and loss. Then we come to the statement of financial position. All right, what is going on in regards to the statement of financial position? So in the statement of financial position, we're looking at a situation now. Remember now we have to increase machinery, all right? Or you can record it as property, plant, and equipment. It is 2.5, all right? Remember, in the statement of financial position, we just record these as one item, which is property, plant, and equipment. All right. Now, in that regard, what is going on here? Remember now, you're going to record your property, plant, and equipment at what value? All right. Your machinery is going up with 50,000, which is the cost. All right. So you're going to take 50,000, which is your cost, minus your depreciation. You did work out the depreciation down there. All right. How much did you calculate as your depreciation? 5,000. All right. So
5,000.
yes. So in this case, that's your depreciation. Remember, we record machinery at carrying amount. All right. We record our assets at carrying amount. So it will then give you this balance. All right. And then let's come to taxation. All right, I need to show you guys something in regards to taxation now so that you can see. I think it was Nerasha was asking me, was it here? No, it was not here. All right, I don't remember who it was asking me if they're examining us on IS-12 income tax. The answer is yes. They'll ask you IS-12, but it will be different to what they asked you on, I think it was on first assessment. They can ask you income tax on changes in accounting estimates. Remember, you have to do the calculation, income tax on prior period errors. Now, let's see, what is the effect of this? So let's quickly see what the information we have in regards to taxation. So the company depreciates machinery at 20% per annum according to straight line method, which is an agreement with their policy applied by the SA Revenue. You see that? Then the SA Revenue Service will also issue a revised assessment in respect of the 2011 tax year. Now, in this regard, right, of course, I'm sure you guys still recall I mentioned that normally in most circumstances when SARS, all right, when SARS agree to open the assessment, it normally result in an adjustment of income tax, all right? But however, now let's look at it. You guys are learned, all right? You have done deferred tax in detail. Let's look at carrying amount, tax base, so that we can see what is going on, and then temporary difference. And then we have deferred tax there. Right, so that we see what is going on. All right, so in this regard, so we have machinery. All right, so we saw there the carrying amount of our machinery. We did the calculation. We saw that it's actually 45,000. All right, we did work it out up there. Now let's look at tax base of machinery. Now, the rate which accountants are using is the rate that SARS is also using, which means now cost is 50,000. All right, and then allowance in 2011. So our allowance for 2011 is also going to be 50,000 times 20% times 6 out of 4. All right, so which would mean, because both are in agreement, all right, so in this regard now, we are going to have a tax base which is sitting at 45,000. So our tax base will be 45,000. Do you guys see that? So in that regard, we then have 45,000 as our tax base. Temporary difference will be 0. carrying amount minus tax versus 0, which would mean, all right, on our note, what is going to happen? We don't have deferred tax, but rather we have increase in income tax. All right, increase in income tax expense. All right, of how much? 45,000 times 20%, which is our tax rate. So in this regard, I will be sitting now with this balance. Right, and then the net effect, of course, it will be our assets went up, right, and then the expense also went up, right. But however, the increase in assets is more than the increase in expenses, which means we end up with resulting in increase in equity, right. So the increase in equity now will be 45,000 minus 12,600, right. So that is how we go about it in regards to this part. So we end up with this balance, 32,400. That is our increase in equity there. Any questions, guys? Questions so far, guys? No question.
So Ian,
Yes, sir.
so now, so what I'm just picking up is that when you are explaining this error stuff, we're just mainly focusing on the net effect on
Yes.
the profit, and then what we take to the retained earnings and all of that. So normally in the exam and in the test, this would be part of the transactions that we need to go through. So it wouldn't be like, we're not going to get like a question for 30 marks out of this concept only. I don't know if maybe I'm wrong by asking that.
Yeah, no, you're actually right. So in this regard, so in terms of 30 marks will be too extreme, all right? I don't think they'll bring 30 marks on each one on prior period errors, but it can range maybe around 10 marks, all right? 10 to 15 marks around there. Because remember now, all right, what they can do, they can ask you the statement of profit and loss, all right, which is where we are going now. They can say, prepare the statement of profit and loss or the statement of changes in equity. And then on the given information, you could be sitting with some prior period errors. Then you have to do some calculations in that regard, which you then need to present in your statements. All right. But like you said, you can't have a 30-mark question on prior period error on its own. You're not preparing the statement of financial position like you saw there. You're just looking at what is the effect on the statement of financial position. That's what you're looking at. Right. But if it so happen, all right, that if it so happen that in the statement of financial position, they ask you, prepare the statement of financial position, what do? All right, if it so happen. So you have your non-current assets, right? So they'll give you property, plant, and equipment for 2011. All right, maybe they gave you property, plant, and equipment for 2011, which is 250,000. So what do you do next? You then have to add the 45,000 so that you have a corrected balance, all right, which is coming in for property, plant, and equipment after you've amended the error. So it will be sitting at this amount. Then you also come to your equity. All right. So in terms of this, maybe they could have given you a retained earnings balance. All right. In this regard. So you then come to your equity. All right. Sorry, you have retained earnings. So in this regard, maybe they gave you retained earnings, which is 50,000. Then you then see, oh, okay, so my equity is going up with 32,400. You then come and edit like this. You see that? So that is how it can also, the prior period errors, it can affect your statement of financial position. Let's look at the statement of profit and loss, all right? So that we complete everything there. So we look at statement of profit and loss as well as the statement of changes in equity so that we see what is happening. So statement of profit and loss and other comprehensive income. Right. So in this regards, you then come sort of fresh, your statements. So let's look at this. They gave us this information. So you can see how we're given this information. So they gave us profit, which is 2012 and 2011. Let's look at it. So 2012, and then we have 2011. Right, let's look at this. So we are given profit before tax. Now, 2011, how are you going to do it? So 2011, you're given a profit of 300,000. See that? So you're given 300,000. You then have to adjust it with the effects. You can see your expenses are going down. All right, so you do have your expenses going down with 45,000. So what do? You add 45,000. I believe I hope Queen is also here. All right, so she can see what the part that she was asking. The reason why we also had to include the expenses as a positive there. All right, you can see now that, remember, expenses, we deduct them from our profit, but however our expenses are going down, that is why we are adding them back. All right. And then in 2012, what is going on in 2012? Now I want you guys to see something. All right. So in the 2012 financials, we're given a balance of 422. All right. That is the balance that they gave us. But however, let's think of it. All right. This 422, which we are given, does it include, let's see, the information is given. All right. If we see if the current year has already been adjusted for or not. Can you see? To date, no adjustment has been made in the accounting records of the company. Now, what does it mean? It means now, when they did these financials, they did not take into account what? The error which was done in 2011. Now, do you agree with me, guys, that in 2012, since there was a machinery which was recorded in 2011, it means the depreciation of that machinery was not accounted for in 2012. So what do? You calculate your depreciation on the machinery in 20. So you're going to take, in 2012, you're going to take now, you're given 422. So your 422 minus what? 50,000, which is the value of our assets, times 20%. What is this? Depreciation for 2012. See that? So in this regards, which means the profit for 2012, you need to also adjust it with depreciation, which was never accounted for. But this is not a prior period error. Why? Because you're correct. The error was identified in the current year. All right, so we're just correcting the financials. All right, so in this regard, that is how you go about it. Then it gives you this profit for 1-2. Any questions so far? Questions, guys? Right. So if there are no questions, I'm glad. All right, I'm glad that we're on the same page. Which would mean now, all right, we have to go back to our income tax. All right, so less income tax. All right, so income tax for 2012, or sorry, 2011. What's going to happen? Do you guys see? So in 2011, the income tax they gave us as 84,000. So we're given 84,000 then. So what do we do with this 84,000? You go to your note. Can you see on your note? There's an increase in income tax of 12,600, which means you have to edit 12,600. So you edit there, all right? So which means now you're going to have 84,000 plus 12,600, like that. So your net income tax now has gone up to 96,600. Right. And then in 2012, all right, your income tax for 2012, what is going to happen? So here you have income tax for 2012, which is 11,8116. Now, remember, SARS is providing wear and tear allowance, which is the same, all right? SARS is providing wear and tear allowance, which is the same as your depreciation. So which means now you need to provide for wear and tear allowance on this, which was never provided for. So your wear and tear allowance is going to be what? It is going to be 50,000 times 20% times 20%. So in this regards, this is your wear and tear, right? Which was never accounted for, right? So in this regard, that is how you do your calculation of income tax. So you have 118,116 minus 50,000 times 20% times 20%, like that. So that is how you're supposed to go about it there. Anyone who's lost so far? We don't want to lose anyone. Is there anyone who feels like they're confused or they're lost somewhere? So this will be your net profit after tax for both the years, 2011 and 2012. Right, so those are your balances, all right? And then let's look at statement of changes in equity. All right, what is going on in the statement of changes in equity? So you have your balance at 1st of January 2011. All right, so you have your balance. Remember, they say they only want to retain the earnings. All right, so in your retained earnings, you take the balance now that you had in the 2010. All right, so what was your balance for 2010? So in this regard, let's quickly go there and see. So statement of changes in equity, this balance, all right, is not affected with prior period errors. Of course, when you did changes in accounting policies, we saw that the opening balance for the prior year is also affected, right? Well, I'm sure you guys recall that. But here, this one is not affected. So it comes, remember the error was only in 2011, which means the balance for 2010 is correct. It's not affected by our error there. All right, so we look at our balance like that. Now, then let's look at other comprehensive income, which is the profit for 2011. All right, what is the profit now for 2011? All right, that is what we now need to look at. All right, what is our profit for 2011? Now, the profit for 2011, we just take this amount that we have calculated there. Remember, we have adjusted the correct profit. So we take the 248,400. 248,400. This is the correct profit for 2011. Right. Is there anything else? We can see there was a dividend that was paid off, 7.5. All right. So we say less dividend paid. 7.5. Right. So in this regard, and then we have our balance at year end. Right. So this is our balance at 31 December 2011. Right. And then the next thing, the next thing now that we need to look at is to look at 2012. So we also do other comprehensive income. Right? Remember, the closing balance for 2011 becomes the opening balance for 2012. So we just continue from there. Now, profit for 2012. All right? How much is our profit now for 2012? So we did work it out is 296,640. So you just record it 296,640 like that. Right. And then from there, we then have, is there any dividend for 2012? You see there's a dividend. All right. Dividends. 10,000. All right. So that's our dividend. And then we have balance at 31 December 2012. So that is our closing balance. So the closing balance will look like this. So that is basically how the prior period error affect our financials. Questions, guys?
Ian, no questions from my side, but I think the questions will start to follow once we start doing the questions by ourselves.
Okay.
And then we can go and see where are you getting your answers and those kind of things.
Okay. All right. No problem. All right. So I remember you guys asking me about questions. So there's another example, all right? Question 4. You can look at this. Example 4. You can run through it. It is change in accounting policy and prior period error. You can look at it and then see if you're able to look to crack it. All right. But otherwise, I have a lot of questions. All right. Question papers, that is prior period errors and change in accounting policies. So for now, look at this one, all right, and see if you're able to answer it right there. Right, then we can see if there are issues or if there's need for additional questions. But of course, like I explained earlier on, that we'll do maybe 1 or 2 revision classes, right, where we cover all the topics which are expected for the upcoming test. All right, but for now, if you guys do not have questions, I just have a few things that I want to address. All right. Yeah, guys, tomorrow, like I said, we need financial calculator. All right. Of course, that one is out. Another thing, guys, be careful with your studies. All right. The reason I'm saying this is there was a friend, all right, was telling me that at their workplace, so apparently there was a lady who was doing articles, all right, and then she was involved in plagiarism, all right, and then so the employers, all right, they constantly ask for her results, and then they found out that she was involved in plagiarism, and so the employers communicated. I'm not sure. We're not sure of the institution, if it's UNISA or UJ, right? I'm not sure which one it is because the friend said he's not 100% sure. But now the institution, no, not the institution, the company, right, did contact the institution, and then they said there's plagiarism. However, the institution did make contact with SAICA in that regard, all right? So apparently, of course, the contract was terminated immediately and all those kind of things, right? I don't mean to scare you guys, but The reason I'm saying this is be careful, guys. All right. The studies are not that difficult, honest. If you give it a little bit of time, push yourself a little bit, you might actually be able to do these things. Believe me, I was where you guys are. Let's give it a best shot. My door is open. If you're stuck, you can always ask me. I'm stuck here. Let's push this other. This is exactly what they'll ask you in the exam. All right, let's not throw our careers over the window with silly things. All right, have a lovely evening, guys. I'll see you guys tomorrow on financial instruments.
Thank you.
Thank
Bye.
you, Rian.
Thank you. Bye.
Bye.
Okay.
Bye-bye.
Bye.